Welcome back. So here we are. It's September 17th. The Bank of Canada has just made an announcement. Josh, thanks for joining us. What happened today?
Well, you know what, Jay? It happened for the first time since March this year. The Bank of Canada finally cut its interest rate again. I know we've been hoping for that to happen as the economy's been weakening, and there's been a lot of uncertainty in the market, especially around the U.S. tariffs and all of this unknown, right? But the Bank of Canada today, September 17th, did cut its interest rate by 0.25%, and it opened up the door to even another interest rate cut later in the year, and we'll talk about that. Now, in the opening statement, the governor, Tiff Macklem, he highlighted that the decision was motivated by three main factors, and that's the softness in the labor market. We've talked about that recently. We'll talk about it a little bit more today. Some recent, more encouraging data on the inflation, especially the core CPI inflation, and also the government's recent decision to remove retaliatory tariffs on most of the imported U.S. goods, which is inflationary as well. So that's really the big reasons behind why the interest rate was able to be cut again. So let's talk about it. Inflation, it is cooperating. We're under 2%. We're at 1.9% in August. It was even a little bit lower in July, but that's largely because of gas prices being low. There's the core inflation, that's the preferred measure for the Bank of Canada to watch. It's been closer to 3%, and it had been nudging up a little bit earlier in the year, which is actually why we hadn't seen these cuts earlier. But the more recent month-over-month data has been, they say, encouraging. And so it's kind of heading back down under that 3%. It's currently at 3.1, but it's heading in the right direction there. You know, last week we got the unemployment reports, or 2 weeks ago we got the unemployment reports. We're at the highest rate of unemployment here in Canada since August of 2021, when we were kind of really into the COVID shutdowns and all of that. Now, the unemployment is heavier in export areas of the economy, a lot of it in Ontario with auto plants and that sort of thing. Obviously, we're feeling it here in Alberta as well. And it feels like it's been bad for a while, but it's not as bad as the 9 to 11% unemployment in that part of the country. But still, that 7.1 is pretty big. So that's another reason. And our GDP is down. We had a bit of a bump in the first quarter of the year as a lot of exports happened before the tariffs came into effect, and then a quick pullback on that in the second quarter. So we're actually at negative 1.5. If we have another quarter of negative GDP, that's officially a recession, if we dare say that word. A recession gives the Bank of Canada more reason to cut rates again, as long as inflation isn't having the opposite impact of things getting too expensive, right? So that's kind of the big reasons why. The GDP contraction is not so much around housing activity and consumption. You know, we're spending money. It's more around business investment and lack of exports in the second quarter.
Well, that's crazy. That's fascinating. And we definitely have seen some impacts here. So we'll keep our eye on what happens next. I do think we'll see maybe a little bit more urgency to get some news out about the GST on new homes as well, I'm sure, this quarter, which might help stimulate. Biggest question I'm getting right now: should I go with the variable still, or should I lock it in? What should I do? What do you got to comment on that?
I absolutely do. There's right now you can get a 5-year fixed rate mortgage for about 3.99 to 4.25. You can get a 5-year variable rate mortgage now with prime lower for about 4%.
Right.
It's about the same. We are expecting probably another 0.25% rate cut before the end of the year in December. There's 2 more rate announcements this year, one in October, one in December. Probably nothing in October. That's just a little bit fast. But December, likely. You know, maybe there will be a third one next year, but not a lot of economists or models are predicting that. And if we look over the next 5 years, kind of by that 2 to 3 year mark, we're expecting the prime rate to start to go back up a little bit. Obviously, forecasts that are this far out are tough to rely on. But by most models, if you take a variable rate today, you are very likely going to pay more over the next 5 years than you would by taking a fixed rate today. So it's a difficult question, yes, but I'm not seeing a lot of reason to encourage most people to take the variable rate unless they're really confident that we're going to see fixed rates lowering in the next bit, which there's not a lot of hope for that, truthfully. But if that's what you really believe and you can afford some increase in payments, sure, take the risk. But it's not a risk
Right.
that I personally would want to take.
I think the only other thing that I tell people is like exactly that, or maybe you're planning to sell within 12 months, makes sense to stay in a variable. But again, Josh, you're the mortgage expert. And so I always defer. Phone and talk to Josh. He'll give you the good advice for your current situation. His number's on the bottom of the screen, as well as mine if you're buying and or selling. Thank you for joining us today. We hope you found this hopeful. Please like, please subscribe. We love the comments. And maybe give us some feedback of what you'd like to see in some future videos. But for now, I hope you have an amazing day, and we'll talk to you again real soon.
Thanks so much.